Hello, we are here to develop financial planning for production. Um, we here we have the user guide. You can read it about how to fill, how to develop it. And here we start here. This is the assumptions, and here you can insert the um, exchange rate, and here you can insert the historic annual inflation. Insert what you want, what is the historic annual inflation, and here you insert the the here where you desire to start to explore the business. 2027. If it's 2027, the inflation is 13. We can put here 2026. It's 12. If we put 2012, it's 15, and it's increasing. And discount rate, the discount rate is 90%. This discount rate is calculated here in financing sources after we insert the bank loan and equity capital, but we will insert it after we know the investment table. Then we will come here to insert the values. Here we have sales volume. For example, we expected to sell 5,000 units or 6,000 units. And here's the corporate income tax. This is the VAT. VAT normal is 16% for at least 1 million rand. Okay, and here's the working hours calculation. The most calculation here are made automatically. All these to know how many hours we needed to work per month. For this to achieve this goal, we needed to insert the number of the days respectively to work days, Saturdays, Sundays, and holidays in work days, holidays in work days, and we must insert the number of hours per week relatively to related to working shift, and you must insert the number of days related to work days per week, including Saturdays. Then we come here to investment table. For example, this is a financial planning for ships, ships, ships productions. So, what is the item we need? We need to invest, for example, one stove, machine. Description of this machine to cook the fry, 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 fry chips, fry chips, and quantity of stoves, one, for example. Unity how much one stove can be more or less. Let's put 6,000 rand. So we will use one item. It's an example. So the total overall investment is 6,000 rands. So now we can go to financing sources and insert financing sources and insert the the total investment. So total will appear here. So for example, equity capital is 5,000 and yeah, 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 5,000. If there are no bank loan, there are no bank loan, the discount rate is 11%. But if we insert the bank loan, let's see, it's to 11%. But if the equity capital increase, okay, same things, okay, same things. But let's put 5,000, 11%, and now we go to the financial planning. Okay. Firstly, we insert here ingredients costs per product unit. For example, get cost per product unit. Let's put 25%, and packaging costs, for example, 2,205, and direct labor cost per product unit, let's put 70%, 70 rand. So automatically we have here the unit cost and cost of the production. So is unit price is calculated automatically here. We have here the revenue volume, and margin 8%. We can put 25%, and 85, but it's a lot. Ships is not too much. It's not too much. But there are any problem here? I will need to decrease the price, the costs here. I will need decrease the cost, but light, okay. Financial investment. Let we can, if we have financial investment, it's good to help to pay expenses. Okay, you can put here 1,000 rand financial investment. The income 1,000, rental property 6,000, 6,000, 6,000, but will not use it for a while. Um, but we can use it. 1,000 rand is our expected income from financial investment, and 6,000 rand is our expected income from rental properties. We can push it, push it. Okay. Now the VAT. The VAT is below 1 million rands. Don't need. And what more? Indirect labor. Go to the indirect labor. For example, we have one director. One director. One tax income is, for example, gross salary. For example, 5,000 rands. And automatically here we have social security, personal income, labor, indirect labor. All these go together to the financial planning, as you see here. Indirect labor, social security, income tax for employees. Now we need third party suppliers. Here we have we inserted electricity, 6,000 of electricity, 600 of electricity, we 200 rand total is here. Yes. Now amortization. Amortization of what? For example, business name. Business name. For example, 200 rand for 5 years. For 5 years. Amortization. Now depreciation. Depreciation of what? Stove. Stove. Yeah, stove. Yeah, stove. It's not it. Stove. Stove. Let me check. What is the investment table? Machine. Yeah. This is a stove. Stove to fry chips. Yeah. Now, yes. Now depreciation. Uh, let's put the stove. The stove cost is how much I put it? How much is it? 6,000 rands. So so amortization, depreciation, 6,000 rands. For this depreciation for 5 years. Depreciation for 5 years. The value is here. The value is here. Now, now, if we can insert reserve fund. Yes, reserve fund. Reserve fund is very important is very important because can help to fulfill to solve future problems. Future problems can come in the future. Some economic problem. The reserve fund can be used for, and it must vary between 5% and 25%. You can see 6%, 9%, at your desire. Now we can check. Oh, net present value is saying the project, this business plan is viable because the net present value is positive. Now let's check the sensitive analysis. Is saying we will need to sell at least 1,814 units. At least we must to sell above this quantity to get profit. To get profit. Yes, to get profit. And the minimum price must be 100%, 100 rands. So we will try to decrease that price, that the costs too, because to reduce the price. Let's try to reduce the price. I have buying. I have booked the price for 50 rands. 50 rands. So it is. I think I'm able to decrease the cost at half. 15, 15 and application cost. Okay, let's see now. Yes. Now yes. Just we can put here two. Yes. Now, now it's good. Let's put direct logs for 35. Okay. Yes. Now it's good. Is it still pro viable? Yes. Very very good. Very good business business fry sheep's business is very profitable. Now we did the financial planning. Now we will talk about the financial control. Financial control. So we have here we have the budget budget control. This is to control between the budgeted the items budgeted like gross revenue volume and the actual performance from the items like gross revenue volume, for example. Now we have here automatically the gross revenue volume for the January for the first year, and the variation is unfavorable because in the actual performance we have no revenue. But if we insert, for example, 30,000 rand, it's favorable because the gross revenue volume is above the gross revenue budgeted. The same thing we do to the, the daily cash budget. Hmm? Same things. Same things. You compare between the revenue budget daily with the actual performance of revenue in the day, in the actual day. Okay, and we have here optimistic scenario. In the optimistic scenario, um, here we can, for example, we can imagine that volume increase 6% and sales volumes decrease 5%. We can put it together here, and the project is still viable because net present value is positive. Same thing we can do here if the independent pessimistic scenario is if the sales volumes increase 9% and costs decrease 5%. Um, what will happen? What do into the for for the business plan in this case is unviable. Let's try to decrease pessimistic revenue decrease 5%. Yes, we can we can try to find a way to the break even where there are no um loss. Okay. Okay, thank you very much. And the financial planning, we can work between the monthly cash budget and the daily cash budget with the optimistic scenario and pessimistic scenario. Okay. Okay, thank you very much for watching.